Hey folks, welcome to InTheMoneyStocks.com's live trading action video. My name is Gareth Soloway, Chief Market Strategist here. Today's date is Tuesday, June 7th, 2016. Well, just taking a look at the S&P 500 today. This is the SPY, the tracking ETF. You can see we've had a gentle float up a majority of the day. You're starting to see a little bit of cracking going on here in the later afternoon session as we approach 3 o'clock, 3 p.m. Eastern Time. But for the most part, look at the volume today, 33 million, and we only have basically an hour left in the trading day. So, yesterday we only did, 55 million, 60 million on the SPY. Today, we're kind of just a little over half of that with 1 hour left. So, you're going to have, I would say there's a good chance today's the lightest trading day of the year. Kind of random being a Tuesday. Tuesday in June. Granted, I think you have to recognize that the summer months are always lighter in volume, but at the same time, it just shows lack of fear in the market, in my opinion. All right, you don't have the institutions buying. I think that's smart money just sitting on the sidelines, but they're aware that the Fed seems to be putting a support underneath the market. Even a bad jobs number, for instance, now the Fed all of a sudden isn't looking like they'll raise rates in June, and the market's able to just gently float up. And again, institutions aren't the ones buying. Smart money's not buying the market, but the little investor is willing to jump in. They don't want to miss this float up, this melt up, and that's enough in the light volume. And that's why you're getting the light volume, enough to get this market floating up. Institutions are just reaping the rewards slowly. Maybe here and there you see a little bit of selling from institutional players. If you look at yesterday, right, or the day before, on my volume candles, you can see that there's a little bit more volume on the red candles, and then all of a sudden it just vanishes, like right here, right, or right here at the end of the day, or right here at the day before at the end of the day there. So that's, to me, a little institutional selling, and they're able to because end of day volume, just like beginning of the day volume, is a little heavier. So the institutions can unload a little there. But notice how the candles right after that are these green candles, and they're just super, super small. So essentially what I think is going on here is you have tiny bit of distribution, but it stops very quickly. The institution steps back as soon as they push the market down just a hair, and then the small investor investing their 100 shares, buying their 100 shares of XYZ, whatever it may be, you get a few thousand of them, a few 100,000 of them, it's enough to lift the market back up, and it just continues to kind of grind here. What's also interesting to me on the SPY is that the low here, it's very controlled. So we talk about computer programs also having a big play in this. So let's say part of the volume is small investors. A very tiny percentage of the volume on the sell candles is institutions distributing, which is selling. And then the other larger portion of volume in the market is just computer programs trading back and forth, what we call algorithms. They're creating a little bit of liquidity. What they're trying to do, these computer programs are set up and run by Goldman Sachs and these other players. They're trying to just scalp a penny here and a penny there. So if they can, sometimes they'll be on the bid and the ask, right? And so if you have on your level 2 Goldman with the 100,000 on one side and 100,000 on the other, and if they're just making that penny spread, well, they're able to make a lot of money throughout the course of the day doing that constantly, on something like the SPY. So again, there's not a lot of volume there, but it's enough for them to grind out a little bit of profitable trading, and that's what they're doing as well. So I think those are the three things that are contributing to the volume in this market, or lack thereof. And I would say small investors probably make up maybe 25% of the volume. I would say institutional distributions are probably 15% of the volume, and you can see those in the red candles. And then, believe it or not, the computer programs, these algorithms, I would say that makes up 75-80%. It's a lot. It's a lot of the percentage of this market, and that's why if you look at the spider, which is the S&P here, from the low here, so here you had selling pressure, and this is where actually emotion was involved, and people were saying, oh, bad jobs numbers, sell, sell, sell. As soon as you got to this kind of 10:30, 11 o'clock time frame, it just shut off. And the algorithms essentially took over. The small investor was also involved there, buying the dip, for instance, although the small investor usually buys more towards the highs. But either way, look at how tight of a range it is. You can almost put a trend line here and just draw it straight up underneath, and notice how you're essentially, and I could even do that, we can even do that right here, right? So, that's not the best one. Let me put it right here. little bit more accurate there. Notice how these lines are almost parallel. So the market is just staying in that range. And that's the computer programs on both sides of the market. They're selling up a little bit, a few pennies, and then they're buying just down a few pennies. And it keeps that market in a very, very tight range for a majority of the volume. Now, the one thing I will say, and I've said this to you guys before, is that in this environment where you have literally 33.5 million traded, most people would say, oh, the market's dead. Yes, it is, but it makes the market actually very vulnerable for a flash crash, another flash crash. And if you've traded for multiple years, you've traded through past flash crashes. I still remember vividly some of the past ones where the market literally on the S&P would drop 10 points every minute or so, and it was incredible. I mean, the downward move was where the markets were down 2%, 3%, 5% in just a short amount of time. And the reasoning I say it's vulnerable for that is because without liquidity, if something were to trigger, let's say something bad happens, you never know what it could be, but something bad happens that the market doesn't expect and it shocks it. Well, you get a lot of sell pressure volume immediately, and there's no one underneath buying the market. So you might have a few small investors with 100 shares here, 100 shares there, but very quickly they're going to step away. And then these algorithms are programmed if the market drops too quickly and gets out of this band here, generally out of this band, they step away. So now they're pulling. So the market already has very little liquidity because the volume is so late. You can clearly see that. They step away, the market has even less liquidity to it, less buyers. And it allows, if someone, let's say just hypothetically, someone dumps 1 million shares, which it could be an institution of the SPY here, or a bunch of contracts of the S&P futures, well, if they just dump that, and they're hoping to get filled within 5 cents, right? 5 cents down on the spiders. Well, if everyone steps away, you might have 5,000 filled at, 212, when we're talking about the spiders here. And then if everyone steps away, it could take, before another 5,000 filled, it could be 211.80. It could be 211.60, 50, 40. And by the time that 1 million shares alone, and 1 million isn't even a lot if you think about even the volume we've done today, by the time that's all filled, the market literally could have just been wiped out $1, $2 to the downside. And now imagine, and I'm speaking in small numbers here, but now imagine that you have a volume day like we did in 2008, where you have 500 million traded on the spiders. And think about those numbers, right? So you literally today, you're probably going to do 45 million. 45 million in the entire day. In 2008, we were doing over 500 million in spiders volume, in S&P volume. So you're less than 10%. Now imagine if that kind of sell volume came back in the market. You would literally get a crash. So, you always hear, the Fed is there to save the day. They put in these circuit breakers. Yeah, but honestly, the Fed can't support the market if you get that type of volume. The Fed does not have trillions of dollars to put in. It would take a lot of money. It would take hundreds of millions of dollars. The Fed's not going to do that. That's like a QE program just to support the market. So they can support it a little bit, but if it got big enough, they can't do anything about it. Could they halt the market? Yeah, they could. But very likely, when it reopens, the panic will be even more intense because people don't like to see their money, held where they can't access it, they can't sell it, and the panic, remember, fear kind of plays off of itself. It grows. You get fearful, and then before you know it, it gets crazier and crazier. So anyways, bottom line is, having said that, markets are down, ticking off this little bearish pattern. Not much to look at. You got the 50 MA here. It's just a very minor downtick. But I do think, again, if you look at 3 consecutive kind of float days, 1, 2, 3, you probably are due for a minor pullback. The question is, does it ever turn into anything bigger? And again, that's what you're really kind of focusing on is there a shock to this market? And you need to be aware of that. I think as an investor, we all need to be aware that while the markets could grind up 1/3% a day for 10 days, all right, so it's 10 days, 10 trading days, that's 3%. The market could literally lose 3-5% in a day very easily because of the lack of volume. So I think you have to evaluate your risk reward there and just be aware of that. I think that's very important. I don't think the average investor really thinks in those terms. The average investor kind of is thinking markets are always going to go up, it's always going to be a happy day, and it's always going to be, this gentle float up. Not that case. There will be a point in time where something crazy happens. Now again, when? Tomorrow, next week, a year from now, who knows? But you do need to be prepared. A smart investor will be prepared for that. Okay? So I just wanted to kind of convey that to you. I think the volume aspect, the most interesting thing about this market and the tight range here, so you understand the computer programs and all that kind of stuff, very, very important. Okay? Enjoy. Come join us at InTheMoneyStocks.com. I will talk to you soon.